Financial Group, and it's the end of summer, which means it's still pretty hot outside. My kids really need to go back to school, and we're probably going to get some volatility here as we get into August and September. It's time for a July update. So last week, the National Bureau of Economic Research announced that the recession is over. And in fact, they announced that the recession ended in April of 2020. That's right, last year. In fact, it was one of the shortest recessions on record, only about a couple of months. And here we are, all this time later, having it announced that we are through the recession, which I think many of us already know. If you've tried to book any travel or even go to a restaurant for dinner, you'll see that everybody's out and about, not just getting back to normal, but making up for lost time. And it's pretty normal that we would have, in fact, on average, recessions are called about 15 months after they've actually ended. So this isn't totally different. And the markets have been moving up pretty steadily since they hit bottom last spring. In fact, the S&P 500 is up 90% from its lows spring of last year. So quite a lot of growth, which is great. But as we talk to clients, we also hear people asking a lot about whether or not the next shoe is going to drop. And I don't know if that's going to necessarily be the case. But it is true that markets are a bit extended and are probably due for a breather. It's no big secret that, and we've been talking about this on our Casual Friday webcast, on our podcasts, and even in these videos, that it's pretty common for August and September to be weak months seasonally in markets. And you combine that with the fact that it's been some time since we've had a 5% dip from the top, or we can't call it a correction, but a 5% dip from the top. We haven't had one since October of last year, and on average we get 3 of those a year. And this year we've had exactly 0. So we're due for one of those. And we usually have, in fact, on average, we have a 10% dip or a 10% correction at least once a year. Obviously, if we haven't had a 5% correction this year, we also haven't had a 10% correction. But we haven't had a 10% or more correction since everything unraveled on us at the onset of COVID last spring. And so looking at both of those measures, whether we're talking about a 5% dip or a 10% dip, we haven't had one in a while, and I don't want to say that we are due, but there are some factors that are kind of swirling that could lead to these averages starting to rear their ugly heads here in the next couple of months. What might the crisis du jour be that could tip us into these 5 or 10% correction points? Well, certainly there's a lot of talk about inflation and what's going on there. There's also some concerns about yields and interest rates. If you watch the news at all, I'm sure you've heard about the Delta variant of COVID, which some fear is could derail our growth or the steady growth that we've had as things have rebounded. Other people are worried that we've had peak growth, which is to say we've maximized the rebound coming out of the COVID recession that we're going to have. I take issue with that a little bit. Just because you're not sprinting doesn't mean you've stopped running. And so there's still probably some growth to be had. But suffice to say, there will be a headline or a crisis du jour that is going to cause some turbulence at the very least, and if not more, like a correction or something along those lines. It wouldn't surprise us one bit if that comes. So if you have a question about how something like this might affect your portfolio, now is the time to email us at info@fordfg.com. Reach out directly to one of our advisors here if you don't have one, or talk to your advisor if you do, and chat about what some of these threats to the market condition might be and how it might affect your portfolio. You know, we're talking specifically about stocks here in this video, but most of you watching this don't own only stocks, and you own stocks and bonds in some varying degree or varying recipe, and so different things can affect that. If the markets take a dip, the bonds might hold in there for you. If interest rates start to spike, that might have a different issue for some of your fixed income or bond investments. So it really is a good time right now as we head into the second half of the year to chat with your advisor about your portfolio, see if there's some rebalancing that needs to be done or some changes that need to be made if they haven't been done already. So thanks for watching this video update. Again, if you need to reach out to us, you can email us at info@fordfg.com. I look forward to talking to you in the next one.